Welcome to My Best Wealth. I'm Marco, and today we have a concept that seems simple until you actually try to use it. Elena, how many times have you seen someone get it wrong?
Hi, everyone. Too many times, Marco. It's one of those concepts everyone thinks they understand. But when you scratch the surface, you realize most people use it backwards. Today, we're going to take it apart piece by piece so it doesn't happen to you.
Today we're talking about the P/E ratio, the most cited metric in the financial world and probably the most misunderstood. Why can a P/E of 60 be cheaper than a P/E of 8?
Exactly. And that's what we're going to prove today. But don't take our word for it. Listen to the data.
Our colleagues will explain it in depth. Carlos, Laura, go ahead.
Imagine discovering that the single stock that looks like the absolute most expensive asset on the entire stock market is actually, well, mathematically speaking, the biggest bargain available.
Right. I mean, you look at the numbers and your brain just completely rejects the contradiction.
Totally. It goes against, every consumer instinct we possess. Like when you walk into a grocery store or a car dealership, a higher price tag universally means something is more expensive.
Yeah, exactly. But the stock market operates on a completely different plane of reality. And applying that grocery store logic to corporate valuation is, well, it's incredibly dangerous.
Okay, let's unpack this, because our mission in this deep dive is to remove the blindfold on a magic number that practically everyone trusts without a second thought.
Oh, absolutely. Everyone uses it.
Right. If you're listening to this right now and you open your brokerage app or, financial news portal, it is sitting right there in bold print next to the ticker symbol, the P/E ratio, the price to earnings multiple.
The holy grail for so many novice investors.
Exactly. And to figure out why this number is actively deceiving us, we've pulled together a massive stack of data. We're looking at the foundational research of valuation expert Aswath Damodaran, historical market averages spanning literally 150 years, and some heavy comparative database pulls.
Yeah, and the real danger we're confronting today is how that single metric takes a hyper-complex, multi-billion-dollar global enterprise and it just condenses its entire existence into 2 digits.
Right, like treating a corporate valuation as if it were a simple final grade on a middle school math test.
Yes, pass or fail, cheap or expensive, it's way too simplistic.
So we all know the basic math, right? It's just the current stock price divided by the company's earnings per share over the last 12 months.
Right, elementary school division.
So you have a $20 stock, $1 a pure profit, your PE is 20. On paper, it basically represents the number of years it would take to break even.
Assuming, of course, that the business freezes its profits exactly where they are today and pays every single cent out to you as a dividend, which, never happens.
Right. And assuming a business will just freeze in time is the first critical error.
Definitely. I mean, a company is a living, breathing entity. It's not a static bond. But that intuitive simplicity, the idea that a lower number just automatically means a shorter time to break even, that's exactly what leads investors straight into our first major myth.
Yeah, this intuitive simplicity totally tricks us when we, sort our portfolios by the cheapest valuation. We assume a bargain basement PE of 4 means buy, and a sky-high PE means run away.
Which is a classic trap.
Let's apply that logic to a broken car. Say you're looking for a vehicle, and you find someone selling a used sedan for $500.
Okay, sounds like a steal.
Right, but you don't blindly buy it just because the absolute dollar amount is low. The price is low because the engine is probably seized, the transmission is shot, and it's practically guaranteed to leave you stranded on the highway on the first mile.
That is a perfect analogy. Yet, investors park their life savings in the stock equivalent of that broken car every single day.
Wow, just chasing the cheap sticker price.
Exactly. The market actually refers to this as a value trap. Damodaran's valuation models make it very clear that a multiple is never just a random number floating in the ether.
So what's actually anchoring it?
It's dictated by 3 fundamental underlying forces. You've got the company's dividend policy, its inherent business risk, and its expected growth trajectory.
Okay, so a low multiple isn't a gift.
No, not at all. A multiple of 4 usually implies the broader market has looked at those exact forces and concluded the company's earnings are about to fall off a cliff.
Wait, I have to stop you there and play devil's advocate for the listener.
Sure, go for it.
You're implying a low number is often a red flag, which makes total sense for dying industries. But what about the flip side? What about a terrifying PE of 80?
Ah, the bubble territory.
Right. History is littered with people who paid multiples of 80 for tech stocks in the dot-com bubble and lost everything. I mean, how is he paying that much for a stock, not just blind gambling?
Well, it becomes gambling when the underlying fundamentals don't support the premium. But if we connect this to the mechanics of growth, you really have to invert the logic of the value trap.
Okay, how so?
Let's say that $1 of profit today is solidly projected based on contracted revenue, to become $10 in 5 years. The multiple expands today, it inflates to 80 because the buyers are actively pricing in that massive future cash flow.
Oh, I see. They aren't paying for a static photo of the company's present.
Exactly. They are paying for the movie of its future.
That's a great way to put it. But if looking at the snapshot of a single company is dangerous, comparing two completely different snapshots has to be worse.
Oh, it's a nightmare.
We have this deeply ingrained habit of putting a modern software company next to, say, a traditional bank, looking at the PE, and declaring the bank the superior investment simply because the number is lower.
Right, and that is what analysts call the apples and pears illusion. Structurally, the technology sector usually operates comfortably at a PE range of 25 to 40.
And the banks?
Financials and energy companies, conversely, they typically sit way down between 8 and 15. Attempting to cross-reference them is just an analytical dead end.
But does the market just arbitrarily penalize concrete and physical assets? I mean, it feels like tech companies get a free pass on valuation, while legacy industries get punished for doing real-world business.
It's not arbitrary at all, actually. Capital intensity is the dividing line here, and it's entirely rational. Think about a traditional bank. It carries what we can basically call a heavy backpack of stones.
Unpack those stones for me. Like, what physical burdens are dragging down a bank's multiple?
Well, look at international banking regulations, right? Like the Basel III capital requirements. A bank is legally mandated to hold billions of dollars in cash reserves that just sit completely idle.
Just dead money.
Exactly, just to satisfy regulators that cannot invest it. Add to that the cost of employing massive compliance departments, leasing thousands of physical branch locations, and taking on complex debt structures just to have capital to lend out.
So to generate $1 extra of profit, they have to freeze mountains of capital.
Precisely. That structural friction fundamentally caps their valuation multiple.
So the traditional business is weighed down by the physical and regulatory world, but tech operates in a completely different reality. It's, well, asset-light.
Yes, asset-light is the perfect term. Once a software company spends the initial research capital to write a code base, the marginal cost to distribute that software to one more user or, 10 million more users is practically zero.
They don't need to build a new factory or hire 1,000 tellers to scale globally.
Right. That infinite scalability generates a massive avalanche of free cash flow without all that debt-laden infrastructure. So naturally, it commands a much higher premium from the market.
This really shifts how we have to look at the entire market. If you pull the historical data since 1871, the stock market's average PE ratio sat around 16.
A very solid industrial average.
Right, but over the last decade, that baseline average has permanently jumped to about 22. And right on cue, market pessimists point to that shift and scream that a crash is imminent because we're historically overvalued.
But they are drawing a completely false equivalence. Damodaran's research notes that the index itself has mutated.
Mutated how?
Well, we aren't living in a 1950s economy dominated by steel mills, railroads, and shipping conglomerates anymore. We operate in a digital, high-margin, asset-light economy.
So the very DNA of the businesses making up the S&P 500 has changed.
Exactly, and that naturally pulls the average multiple upward. Applying a 1950s industrial average to a 2020s digital ecosystem is, frankly, mathematically incoherent.
Okay, so tech companies aren't dragging around physical factories. But that asset-light model creates a completely different and arguably scarier problem for the PE ratio.
Oh, you mean when the math literally breaks?
Exactly. What happens when there are no earnings at all? When a company posts negative profits, the whole equation just collapses. You try to divide by a negative number or zero, and you just get an error code on your calculator.
And institutional panic often sets in right at that error code. The immediate assumption from novice investors is that the business model is fundamentally broken and just hemorrhaging cash.
Right, so I want you to imagine buying an orchard. You go out, you buy the best land, you purchase top-tier tractors, you hire the smartest agronomist, and you install a massive, high-tech irrigation system.
Okay, so an enormous upfront capital expenditure.
Exactly. Massive debt. And a month later, an accountant walks up to you and asks, "So how many tomatoes did you sell? Let's calculate your return on investment."
The honest answer is 0. You haven't sold a single tomato, and your balance sheet is deep in the red.
Does that mean your orchard is a failed business?
Obviously not.
No. The value isn't in today's non-existent harvest. The value is in the infrastructure you just built and its capacity to produce and dominate tomato production for the next 30 years. If you only look at today's earnings, you completely miss the architecture of long-term value creation.
That is spot on. And the historical twin to your orchard analogy is Amazon in 1999.
Oh, perfect example.
Back then, Amazon purposely made the strategic decision to take nearly every single dollar that came through the door and plow it directly back into building the world's most dominant logistics network.
So they weren't even trying to show a profit.
Not at all. Their immediate goal was not to show a tidy net profit for Wall Street. Their goal was to eat global market share.
Sure, Amazon worked out spectacularly. But for every Amazon in 1999, there were 20 dot-com startups that went to zero. They didn't have sustained net earnings until around 2003.
Right, it was a bloodbath for a lot of them.
But anyone purely screening for positive PE ratios back in 1999 would have completely missed one of the greatest wealth creators in the history of capitalism. But I have to ask, does this temporary lack of earnings only apply to wild tech startups?
No, not at all. It heavily impacts traditional, highly cyclical companies as well. Consider a perfectly healthy oil major during a temporary, say, 6-month crash in global crude prices. They might post brutal net losses for 2 consecutive quarters.
Right, so their PE ratio goes negative.
Exactly. But their physical offshore rigs haven't vanished. The oil reserves are still in the ground. They're simply operating in a temporary macroeconomic valley. Once the commodity cycle turns, the profits aggressively rebound.
So if the PE ratio goes completely blind when a company dips into negative earnings, how are the pros actually valuing these businesses? I mean, institutional investors aren't just flying on intuition.
No, they have a whole toolkit. They migrate up the income statement or they move over to the cash flow statement to find metrics that aren't distorted by temporary investments or paper accounting rules.
Okay, so what's the go-to for, say, those early stage companies, like Amazon in its orchard building phase?
For them, they look at the price to sales ratio, or PS. It measures how much you're paying for the top-line revenue they bring in, giving you a real sense of their market traction regardless of current profitability.
That makes a lot of sense for startups where revenue growth is the whole story. But what about the heavy industry guys? The ones dragging those stones we talked about?
For heavy machinery, airlines, or telecom companies, analysts use enterprise value to EBITDA, or EV to EBITDA.
Okay, that sounds like a mouthful. Why does that metric matter mechanically?
Well, here is why it matters. When an airline buys a massive fleet of jets, the tax code forces them to deduct that cost slowly over decades through a process called depreciation.
Right, wearing down the asset over time.
Exactly. But that depreciation artificially shrinks their net income on paper today, making their PE look wildly inflated. EBITDA strips out that paper deduction, along with taxes and interest.
So it basically gives you a clear view of the actual physical cash the business operations are printing.
Bingo. It removes the accounting noise.
And for the banks, since their inventory is literally just money.
For banks, they rely heavily on the price-to-book ratio, or PB. Since a bank's core engine is its equity, the actual capital it has on hand to absorb loan losses, the price-to-book tells you how much of a premium you are paying over the literal liquidation value of the bank's assets.
Okay. That makes sense.
And just generally, we also see a heavy reliance across the board on price-to-free cash flow, or PFCF, because while net income can be manipulated by accounting assumptions, the actual cash entering and leaving the bank account cannot lie.
Okay, let me recap this because it's a lot. So the PE ratio fails when you compare apples to pears across different sectors.
Right.
It mathematically collapses when a company doesn't have immediate profits.
Yeah.
And most dangerously, it completely ignores how fast a company's profits are growing. We need the magic missing piece to make the valuation actually useful.
And that missing piece is the PEG ratio, PEG, price earnings to growth. It is an incredibly elegant mathematical solution to the PE's biggest blind spot.
Okay, so how does the math actually work to fix the blind spot?
It's surprisingly simple. You take that flawed PE ratio we've been dissecting all day, and you just divide it by the expected annual growth rate of the company's earnings.
So by injecting the growth rate into the denominator of the equation, you're finally giving the valuation the dimension of time.
Exactly. It transforms a static snapshot into a trajectory. The legendary fund manager Peter Lynch popularized this as his golden rule for valuation.
Oh, right. What was his specific benchmark?
He argued that a PEG ratio of exactly 1.0 means the stock is trading at absolute fair value. The premium you pay today is perfectly neutralized by the growth you are receiving tomorrow.
Got it. So anything above 1.0 means you're overpaying for that growth. But if it falls below 1.0,
If the PEG sits below 1.0, the market is effectively selling you future growth at a discount. It represents a mathematical bargain.
this brings us directly to the real-world case study we promised. And honestly, it's going to challenge everything you think you know about expensive stocks.
Oh, this is my favorite part.
I want to set up the ring for a heavyweight bout looking at 2024 and 2025. In one corner, we have NVIDIA, the undisputed king of AI hardware.
A total juggernaut.
Right. Trading around $130 a share with an astronomical PE ratio of 65. Now, in the other corner, representing the old economy, we have Banco Santander, trading around €4.80 with a tiny bargain basement PE of 6.5.
The visual contrast is just staggering. I mean, an amateur investor scanning a screener would look at those two numbers, buy the bank immediately, and flee from the semiconductor stock.
Because 65 is obviously too high, and 6.5 is obviously cheap.
Exactly.
Let's dissect the engines under the hood using everything we've just learned about growth and capital intensity.
Well, Santander is an incredibly mature business. It grows its bottom line profits at a respectable 8% a year, and it operates with roughly 15% net margins.
But it's carrying that massive regulatory backpack we discussed earlier.
Right. Every single dollar of that 8% growth is a massive heavy lift against interest rate vulnerability and capital reserve requirements.
Now compare that to NVIDIA's engine. NVIDIA operates with roughly 55% net margins.
Which is insane.
It is. More than half of every single $100 they bring in is pure, unadulterated profit because of their absolute monopoly on AI chips and their impenetrable software moat. And they aren't growing at 8%. Driven by the global AI infrastructure build-out, their profits are compounding at a historic 120% year-over-year.
Okay, so now we apply the magic math and calculate the PEG ratio for both assets.
Walk me through the numbers.
Let's start with Santander. We take its PE of 6.5 and divide it by its 8% growth rate. That gives us a PEG ratio of 0.75.
Okay, a PEG of 0.75 is below 1.0. So based on Peter Lynch's rule, Santander is an attractive discount. It's a solid, fair value. But what happens when we run the same math on NVIDIA?
We take NVIDIA's terrifying PE multiple of 65 and we divide it by its massive 120% growth trajectory. The result is a PEG ratio of 0.27.
0.27. Let that sink in for a moment. Mathematically speaking, when you factor in the velocity of growth, stock trading at 65 times its earnings is significantly cheaper than the stock trading at 6 times its earnings.
I know, it sounds impossible until you actually run the mechanics.
The PE ratio alone merely tells you the ticket price for the ride today. But the PEG ratio tells you what kind of vehicle that ticket gets you onto. Are you buying a ticket for a bicycle, like Santander, or are you buying a ticket for a spaceship, like NVIDIA?
Exactly. The high upfront multiple for NVIDIA is completely justified by the sheer avalanche of future cash coming down the pipeline.
Now, before we synthesize this into our final rules, there is one last, incredibly provocative thought from Damodaran's research that completely upends how we define corporate success.
Yeah, this is huge. It questions the very foundation of what constitutes a profit.
This might actually be the most mind-bending part of the entire analysis. We have a massive systemic flaw in how international accounting standards handle R&D research and development.
Right. Think about the mechanics of legacy accounting. Imagine a 20th century industrial company decides to build a massive physical cement factory.
Okay, lots of bricks and steel.
Under the rules, that factory is capitalized. It's recorded on the balance sheet as a long-term asset, and the company gets to amortize the cost of that factory slowly over 30 years. The actual hit to their net income this specific year is incredibly minimal.
But stepped into the 21st century. Imagine a modern tech giant or a cutting-edge pharmaceutical firm. They spend $5 billion developing a revolutionary software algorithm or, say, a life-saving biologic drug.
Regulators force them to expense that entire $5 billion immediately. In the eyes of the accountants, spending $5 billion on an algorithm that will generate revenue for a decade is treated exactly the same as buying printer paper for the break room.
That is wild. And that aggressive expensing artificially sinks the net profits of technology companies today.
Exactly. They look like they have a massive bloated PE ratio, not because they are overvalued or failing, but because they are aggressively investing billions into cementing their future market dominance.
So if those R&D costs were capitalized as long-term investments, treated exactly like the physical cement factory, their profits today would look significantly higher.
And as a direct mathematical result, their PE ratios would look drastically cheaper overnight.
It raises the terrifying possibility that the entire financial market is reacting to metrics manipulated by obsolete 20th century smokestack accounting rules being forcefully applied to 21st century innovation.
It really does, which perfectly sets up the 3 golden rules we want you to take away from this deep dive.
Right, so how should the listener navigate this minefield?
First, the PE ratio demands strict sector context. Always compare apples to apples. Never benchmark a capital-heavy bank against an asset-light software company.
Makes total sense. And the second rule.
Second, always check under the hood for value traps. A low multiple isn't the gift, it's usually a seized engine.
Right, the broken car. And a third.
Third, never look at price without looking at speed. Always cross-reference the valuation multiple with the growth velocity using the PEG ratio.
Perfect. So if you're listening to this and looking at your portfolio right now, remember that the next time you see a loud, bold headline condemning a stock as a massive bubble purely based on a 2-digit number, that number is just the tip of the iceberg.
It rarely tells the whole story.
Exactly. Don't let the simplicity of a middle school math equation hide the complex, fascinating reality of the actual business underneath. Keep your eyes open, look past the basic division, and figure out if you're buying a broken car or a spaceship.
Thanks, Carlos. Thanks, Laura. Great explanation as always.
Well, there you have it. As always, we analyze, you decide. If you want to go deeper, at mybestwealth.com, we have the full reports where we apply these concepts to real companies, with all the charts and data.
And one important thing, leave us in the comments which concept you'd like us to explain in the next episode. The best ideas come from you. If you found this useful, subscribe and hit the bell so you don't miss any episode of this series. And remember, this content is educational and informational. It does not constitute personalized financial advice. Take care and see you soon.
Until the next concept, take care.